Well, good morning, everybody. Live this month from Las Vegas, Nevada, Garth and I have decided to continue our traveling show. We don't even know where we're going to be next month when we get to part three. We're ourselves eagerly anticipating the reveal of that next location, but we're here together again. We enjoyed it so much that we decided to get together again in person to present what is now going to be part two of the new housing services ecosystem. And today we're going to talk about who owns the customer relationship.
Yeah, it's terrific to be here in Vegas. Here's the crazy part. Last time we were in Arizona and we got a really nice natural background.
Yeah.
Today we were in Vegas and there is no natural background in Vegas. Actually, we were thinking it was going to be this amazing mountainous backdrop, beautiful, but the technology challenges, it completely washes out and you wouldn't see us. And I know that's what they're here for.
Yeah, and you've got to take it our word for it that it's really beautiful.
It's beautiful. So instead, you get the whole Vegas. So just think of Elvis is about to come out and do Hound Dog in his prime, and this is the curtain. So, or just imagine that it's us in front of a creepy curtain in our same hotel room. And now that I've done this intro, this is kind of this is actually creepy. So let's just get to the content.
Yeah, these are great visuals for our audience.
Exactly.
So again, I'm Coby Hakalir. I'm the VP of Mortgage Banking and Core Services at T360. Really happy to be here. And Garth, why don't you introduce yourself?
Sure. Garth Graham. I'm the senior partner with STRATMOR Group, consulting firm for the mortgage industry, and road warrior, I guess.
Absolutely.
I'm starting my 39th year in mortgage banking. Somebody reminded me that recently, and I said, gosh, thanks. So it's my 39th year, and I'll try to bring you at least a little bit my experience during session 2, who owns the customer. So let's talk about it.
Big celebration coming next year for 40. Huh?
Yeah, apparently.
So again, we last month we talked to you about why now. And what is bringing the industries together? What are some of the factors at play? We took it all the way from the 1970s and we brought it to today.
Exactly.
We played all the greatest hits. And today we're going to talk about who owns the customer relationship. What I can tell you before we get into this is that by the end of this, we're not going to have a definitive answer for you.
Yeah.
Because there is no definitive answer. There are so many complex layers and nuanced layers at play when it comes to who owns the customer relationship. That's what makes our industry so complex and intriguing and really interesting to talk about. And as we kind of enter this new era that we're in right now, we're all trying to figure it out, right?
Yeah, absolutely. And the whole concept of the vertical integration is not binary. It's not either you do vertical integration such as Rocket and Redfin, Mr. Cooper is engaged on, or you don't. It can be something in between, but you need some level of strategy around it. So we should probably recap a little bit for part 1, although they can see it in the whatever platform you're watching this on, the part 1 video. If you're just joining us now, you can go back and watch the part 1 video. But here's the greatest hits from that.
Yeah, Garth, take us through the recap real quick.
Yeah, so I think the big thing that we really pointed out is that borrowers really, when they're buying a home, and that's really what this is about. We're not really getting into kind of the refinance activity, part of the mortgage banking part. But when buyers are buying a house, it really is one journey. We, as an industry, due to some of the historical perspectives and the regulation, have broken it into pieces, in multiple pieces, but it's really one big journey. We think from a human perspective, we should look at it. What is the borrower's full journey? And then how do we fit into it? Regulation, of course, is always a big factor, and we covered that in number 1. So if you just love talking about compliance and regulation and the legal impacts, go back and watch part 1. We came up with, there's really 5 barriers in number 1 that we talked about in trying to get some level of vertical integration, culture, compliance, technology, incentives, and ultimately the consumer anxiety around the process. We talked about that, but we certainly, and I don't know if you want to pick up on the next one here, but the platform era is a big, big part, of what we are sort of entering now. And we've seen some of these in the past. The big item is we are in a period of consolidation in both real estate and mortgage. There's no doubt about it. And we shared some of those statistics. That is coming in the fact of companies being sold, about 150 transactions in the last 4 years on the mortgage side. There's been about a 50% reduction in the number of loan officers that are involved in our industry since the 2021 peak. And then the number of lenders really of size and scale is shrinking.
That's right.
So, the bigger getting bigger in some cases, and that, the smaller, many of them are going through a period of consolidation.
Yeah, we talked about 80,000 relevant loan officers,
Relevant
right?
loan officers.
80,000 loan officers that are closing at least 1 or 2 deals a month. 71% of agents not having closed a deal at all in the last year. So
That's
really,
crazy.
really a phenomenal period that we're in. Let's talk about the 8 Ds of real estate, because we had some discussion around this and it's pretty cool.
Yeah, actually, yesterday, by the way, I ran into Mark Fleming. Mark Fleming is the chief economist for First American, and I remember hearing him on his podcast, which is pretty interesting. He's for an economist, he's kind of funny. So he's got a pretty good, interesting podcast if you want to listen to it. But he talks about the 5 Ds, and this is a thing that's been around forever. So free bonus content today is I'm adding 60% to the Ds.
Wow.
So I've come up with the 8 Ds. Here's the reason I bring this up. When we're about to talk about who owns the customer, what it really is to me, it's not ownership, it's engagement. Who engages with the customer best based on their needs? And their needs is not a loan. Their needs barely is a house. Their needs is something else that makes them buy the house. So this is, focused. If you're getting into the investor piece, it's cash flow. But for the most part, these 8 Ds, and I love the mnemonic devices because it makes you remember, is the concept of diapers, i.e. you had a kid.
Yeah.
Divorce, you need 2 homes, not 1. Downsizing, kid went off to college. Your distance from work, too close or too far. So remote work, I can move a little farther away. Got to go back to work, I can move closer in. Death is often a factor in why people are doing it. And that includes whether they inherit money or some death in the family of some sort. Diamonds, of course, is implying the matrimony, the concept of getting married, getting a house. The other one that we are seeing, and this is where I started to add a few, is debt. And the reason I say that is there are people who are looking to buy another home because the house they're in, they can't quite afford.
Yeah.
Taxes and insurance have gone up as a notable one. And then the last one I bring up is doing good. And, obviously I took a license a little bit with this one. And what that is somebody who has had some sort of economic benefit happen to them, raise at work or whatever it might be. They're doing well, and they would like to have a bigger home and are prepared to invest in it.
The move up buyer.
Yeah. So the reason I bring it up is we don't own the customer. They own their journey. And their journey on purchase is based on some critical need that is something very personable to them. So the person or people who engage best with the consumer on their true need, which is usually one of these 8 Ds, is the one who's going to likely add value and have the best opportunity to work with that consumer.
Yeah, I think just a side note here, if you're a loan officer and you're thinking that customers are really concerned about interest rate and fees, they're not. They're concerned with what the next stage of their life is going to be, and they're looking to you for that guidance.
100%. We've actually got some stats on it.
That's right. So talk about this. Who best connected with your customer? We've kind of honed in on this word connection.
Yes,
because it's important, because when the customer feels heard, when they feel seen, when they feel that their needs are being addressed, and you take the time, whether you're the agent or the loan officer, to actually address those needs, that's the basis of forming the connection.
Yeah, I think one of the biggest thing that we see here is, and we do a bunch of secret shopper type work for lenders, and actually we do it for real estate as well. But what we do when we do secret shoppers, we try to replicate the human's experience in engaging with the lender. What we often see is the missed opportunity associated with why the consumer is getting the loan. And what they do, and it's a natural inclination, is on the loan origination side, is you slip into transaction mode, which with refinance is fine. What's your old loan? What's your new loan? I can save you money. Do you want it? I mean, that's really the pitch, and I'm simplifying, but not by much. On a purchase, if you were not a loan officer, and as I sometimes say when I do this public speaking, I'll say, just pretend you're human and not a loan officer. And what I mean by that is, if somebody said to you, I'm buying a home, what would be your first question or comment? It would be, wow, that's exciting. Why?
Yeah.
And what we tend to do is we shift into transaction mode. Oh, how much are you putting down on the home? That is literally playing into then what is the consumer's going to go into transaction mode too. Yeah. When really that journey is what they're trying to engage on, which is one of the reasons. So it's really, how do you best connect with the customer that's going to drive this.
And if you're an agent, you're already thinking about, setting up the home search. If you're the loan officer, your mind is going into completing the 1003 mentally.
Exactly.
And we're skipping over the part of building rapport and building trust. Dale Vermillion's in the house. I know he's here today. I know he'd have something to say about that.
Yeah, absolutely.
So what does it mean to own a customer relationship? And, we're going to use words like connection. We're going to use words like ownership. Garth's already let the cat out of the bag that the customer owns their journey and their relationship.
Yeah.
But what are we talking about when it comes to things like data and trust and recency and revenue? Like, what are some of these things that we need to be on the lookout for?
Well, yeah, I think that the tricky part in the data part is the borrowers or buyers may from time to time share critical data as part of their transaction. It's incumbent on you to track it, store it, and then monitor for changes over time. Because somebody calling you in March may not transact until September and might list their home in August. And if you don't have some sort of visibility of the changes that might occur over that time, if you're a realtor or a loan officer, you're in essence not getting enough data to really understand what their picture is.
Mm-hmm.
So I think that's one of the biggest items. You want to tackle the next one?
Yeah, if we talk about trust, right? We talked about forming that connection with the borrower, getting them to, they're telling you, their deepest, darkest secrets when you're talking about, especially if you're on the loan officer side, you're talking about, dings on their credit. You're talking about, the reason that they're moving that may be, a sensitive topic. It may be the death or the divorce or something or debt or something that's not entirely pleasant.
Mm-hmm.
If you're the agent, you're uncovering things that are important to them in a home, then you're trying to uncover things that they may not know are important with the home. Recency, who last connected with them, who's keeping in touch with them. We see a lot of failure on this in the post-close environment where we've looked at the transaction as a transaction instead of the beginning of a relationship. And that causes us to do all kinds of weird things post-close. Like we go from, understanding these customers and being on a very simpatico emotional level with them to, sending them football schedules and recipes for apple pie on July 4th. And we think that we're continuing some sort of relationship, something we would never do if it was a friend of ours. We would keep in touch. And so we make that mistake in our industry. And we'll talk later in this webinar about what that costs us in the long run. And the revenue ownership, of course, this has to do with, the customers. It is a transaction at the end of the day, although we want it to be a relational moment, but there is revenue attached to it. That dynamic has shifted as the servicers have played a bigger role in it, as the industries have kind of seen the vertical integration. That revenue ownership has become a little more murky, and we're all trying to figure that out. But there's all these different elements in there that contribute to the ownership of the relationship and the dynamics that play out.
Absolutely. And by the way, that one's the one that gets the headlines. So I'm always sort of frustrated by that because it's like the revenue is the headline number, but to me, the other ones are almost much more important. That's how you would end up getting the revenue.
Burying the lead here. So do you agree with this? The agent historically owned the relationship?
Absolutely. So as I said, I started 39 years ago in this industry. The first job I had was a loan officer. So, picture me in my Kuppenheimer suit and my Toyota Tercel and my going out and meeting realtors. That was the way. And I got some business and I figured it out from financial planners and, other financial institutions. But it mostly was a real estate referral part. You were dead if you could not get business from a referral from a realtor. So historically, this is absolutely true, but we're going to show you some numbers that we have from STRATMOR from our survey process that would indicate it's not quite as prevalent, in fact, nowhere near as prevalent, that the realtor owns the relationship in the way in which they used to.
Garth, I have a distinct memory of picking up donuts from Dunkin'
Oh,
Donuts
100%.
and dropping them off at real estate offices. And I remember I would tape my card to the box.
Yeah.
And then I thought, well, what happens if somebody comes by and takes a donut and the card falls off? So I started stapling my card to the box.
Oh, man,
that was my big marketing discovery.
It's a lot. That's embracing technology. I'm proud of you.
It was a game changer for me.
Yes.
Does the brokerage own it? And so this is part of the conversation that we have often in our industry, especially on the lender side, where we talk about, is it the lender, is it the loan officer, is it the brokerage, or is it the agent that owns the relationship? And this is not really to start an argument about who owns the spreadsheet and who owns it. It's more, who's responsible for keeping that relationship going? Who does the customer look to, and who do they remember after they close? Are they thinking about the Century 21 brand or the Remax brand, or are they thinking about the agent, or are both getting lost to them? And the same thing on the lender side. But does the brokerage own it, Garth?
Yeah, I mean, you guys are the sort of the more experts on the real estate related side, but agents seem to also switch. They pick up and take their book of business, and they will go from one agency or brokerage to another. You see very much the same thing in the mortgage side as well. I will say this though, in the top 20% of loan officers, the attrition rate, i.e. what percent of them leave, is small. It's 10 to 20%.
Yeah.
So it's our overall attrition on loan officer, the switching number is about 40%, but it's really 10 to 20% of high producers. So generally, if they're successful, they stick with it because they have some level of partnership and or their own internal trust with the company that employs them, or in this case, with the brokerage where they, hang their license.
Yeah. So in this case, the agent says, hey, it's my customer. I found them. I showed them a house. I took them through the process. The broker says, well, you did all of that under our brand. The transaction and the escrow and all of the earnest money, all of that was in our accounts. We handled all of that. This was our transaction. It's our customer. And so this dynamic plays out across our industry. And often what happens is this fight happens, and who gets left in the cold? The customer.
The customer, yeah.
So the loan officer says, I brought the referral. That's my client, right? So Garth, tell me about the loan officer.
Yeah, so it's very, very similar to what you just said. They may get that from the realtor, although, as I said, I'm going to have some slides in a second that show what influenced the various recommendations and the process that the consumer gets in making the decision about the loan. But I got the referral, therefore I owned the referral. They certainly, and especially in this climate, in the mortgage space, we are collecting private confidential data, PII, for sure.
Yeah.
It's PII. Heck, if you got email addresses, you got PII, but you also have income and everything else. Lenders bear a significant level of risk if that data goes outside the four walls of their company.
That's right.
Because the customer shared it with the company. They didn't share it with the loan officer, frankly. They shared it with the loan officer who is a licensed individual working for the company. So this one, it's like the data is owned by the company. The issue, though, is the relationship is mostly being owned by the loan officer in the traditional retail model. Where we are seeing that different is in some of the consumer direct models where it is more owned by the company, and the loan officer's role is really being plugged in because the referral came from the company.
Yeah. And you mentioned the loan officers that stay, but there's so many loan officers that do leave every 2-3 years.
Yeah.
I think what the average is it about 2 to 3 years?
Yeah.
And so you've got a customer that closed a loan with Joe at, let's call it XYZ lender. And then year after that, the loan officer doesn't work there anymore. The loan is now being serviced somewhere else. And so that entire relationship that the customer had, whether it was with both the lender itself and the mortgage company itself and the loan officer, is now entirely in someone else's hands, and nobody's reaching out to them and doing an effective job of keeping in touch.
Well, or the amount of research,
except for the servicer,
the amount of research outreach they may be getting from multiple parties is confusing.
That's right.
Because so let's just, for the sake of argument, say everybody reached out. You'd be like, how many times? I just closed 6 months ago, but now you guys are still pelting me.
And we have a hard enough time, on the inside baseball part of this, understanding servicing and sub-servicing and who's reaching out and what the rules are. And if you imagine being the customer who goes through this, 3 times in their life, trying to navigate through all of this. And, oh, by the way, their taxes and insurance are paid through the servicer for the most part. And so they're trying to figure out, make sure that that's done correctly. And if they have a problem, who do I go to?
Exactly.
And so some of that falls apart in the servicing side. And we'll talk about that later.
One thing, and I pretty much just covered this one in the talk track on my slide number 9 was kind of it having to do with this. The mortgage company, especially in the collection of the PII, has responsibility and kind of owns it. The one thing I will comment here, though.
And has a liability.
Absolutely. In the last few years, there's a significant growth in data companies that aggregate data at household levels. So imagine there's 300 million households in the United States of America. There's databases that are being aggregated and updated on all of them.
That's right.
You can get access to that data for permissible purposes, and anybody can reach out to us and we can talk through the details. But if you were a loan officer you don't have to take the database from the previous customer. You can rebuild the database when you go to the next company. And I'm not advocating loan officers should quit their job and go to a new company and then, go through a whole hydration process to recreate their database. I'm saying, though, that it's possible. And 5 years ago, it was really not. It was very, very difficult. It's gotten a lot easier. You won't have necessarily all the information, but enough that needs to stay with the lender. But you certainly can restart over. And it's the same thing, I think, in real estate, too. I mean, the data shows that this realtor worked with this customer, that worked with this lender, that worked with the builder, if there was one, with this title company. And you could aggregate that information or create your own database of past customers and not do it the way, unfortunately, some people do, which is try to take it with them.
That's right.
So I think that's one of the elements of, it's risky and kind of unethical to take your database that the company aggregated and is responsible for.
And part of that is there is a lack of clarity around this and a lack of clarity about who owns this relationship. And I think that kind of is the baseline for some of these problems that we see.
Exactly. And of course, as it's okay to say I own the data. You don't own the relationship, the consumer does. But at some point, having the data gives you the best shot to then have the engagement that enables you to maintain a relationship.
Yeah, certainly clearer conversations around that would be helpful.
Exactly. So here's where we're going to get into some darn interesting data.
Yeah. So let's talk about what the consumer actually does. We talk about what we do and the customer journey and how we can put them in the funnel, and we're widgetizing the customer in a sense, because we're predicting their behavior. They're going to search here, then they're going to call us there, then they're going to fill out a form here, and then voila, we've got a closed customer. But what are they actually doing? 74% of them said they would use their agent again. So that means that most of them are getting through this process and they're having a pretty okay experience. Yeah. And I say pretty okay because we'll get into some of the net positive scoring afterwards and talk about that. But 74% of them said they would actually use their agent again. I suspect that number is about the same for loan officers.
Yeah, very high. Yeah. The average loan officer, if you look at 5-star ratings, gets about a 4.75 out of 5. But I'm going to say that be careful thinking that that's the full story. So we'll talk about that in a second. But yeah, they tend to like their realtor and loan officer, those that close, because they successfully closed.
But here's where it falls off the cliff, right? About 18% actually go back to the same lender.
Yep.
And we see that vary among the different kinds of lending relationships that are out there.
Yeah, we're gonna talk about that in a second for sure.
Talk about that. Less than 12% of consumers remember who their LOs are
after a year.
Yeah.
So in other words, they'll vaguely, and it's just like, think about you being a human. You meet someone, you have a great conversation. You might maintain that conversation over 30 days because you have some business relationship. But a year later, you're like, what was that guy's name again?
Yeah.
And so at some point, being on the name, you as the person involved in it might vividly remember that consumer for some reason, but it's going to wane over time unless you have a legitimate and positive way to remind them.
Yeah. Just unbelievable to go through, a 45-day process on average. That has an emotional toll to it, that has a lot of pressure on it.
Yeah.
And 88% of folks are forgetting the person who helped navigate them through that.
Yeah.
That's a staggering number.
By the way, that is only being more and more problematic because we all know one of the inventory challenges and things that's happening in our industry right now is you have so many people at these low coupons, 3% rates. So they're saying and voting with their feet, meaning not moving their feet. I'm staying where I'm at. And I might even do a little bit of home improvements, but I'm not giving up a 3% loan. So what that's going to mean is they're going to go 5, 6, 7 years, before they even think about another. So now you're asking them to remember the experience and remember you 7 years later. It's incumbent on you to remind them and engage with them on that experience.
And even if you're not in a pandemic era, low interest rate environment, this number here tells a story, 18 to 24 months in between housing decisions. So if 88% are forgetting the loan officer's name after 12 months, and the next big decision is coming 6 or 12 months later after that, well, that gives you all you need to know.
Exactly.
By the time they're ready for that next decision, they've forgotten you.
Exactly. So I think this one's, there's a few here that are very interesting. And the left side is the purchase of a home, and the right side is the refinance of a home. And the reason I give you the refinance, once again, we're talking primarily about purchase, but just to show the difference associated with the little black dots, by the way, are NPS scores. So that's the Russell equivalent of how satisfied was the lender based on these various criteria. So when we survey these consumers, and we've done over 1 million consumer surveys, what we find out, and we ask them, and there's going to be 3 slides on this, what was the first course of action in your journey? And when it's a purchase, what they say, 36% of the time, they say, I searched for a home online. That's the first thing I did. 36%. 35% say I engaged an agent. So I'm back to literally where when I started in the industry, that engaged an agent was 75% plus.
Well,
I wish I had.
You had no choice.
Yeah, well, and I don't have the data, but I know what it was because I was out in the Kuppenheimer suit trying to get them. So that is roughly an equal split between those that are searching online and those that engaged an agent. And by the way, their satisfaction scores are roughly the same regardless of which they did first. The reach out to the lender loan officer is about 13%, and then ask friends and family is about 7%. So 20% is he did something on the lending side, and 33% is I engaged with a realtor. So it is not as dominant, but that online search is really the element that was, pretty much the powerhouse activity. By the way, on refinance, and this is where mortgage has, an advantage over real estate, is we have these subsequent refinance transactions. Right. 54% of people say I reached out to my existing mortgage servicer. That was the first action that I took. And 17% I reached out to my loan officer. So definitely the servicer piece, because it's the tap, tap, tap every month. You remember who the servicer is because you're paying them. You may not remember the loan officer's name for all the reasons we just said. Yeah. And that's what's kind of showing up right here. 19% the loan officer reached out to me. So I reach out to them as frequently as they reach out to me illustrates the point of saying, are you sure you're reaching out to them at the right time with the right message in order to be able to maintain that relationship? So we're going to spend most of our data here talking about purchase, but I just wanted to share that one because I think it's kind of interesting.
Yeah, and it underscores your point that the refinance is a little bit more transactional in its nature because you're just exchanging value and dollars for less dollars.
Exactly.
But the home search journey, that to me is interesting when you think about, you had no choice back in the 80s, back in the 90s. If you wanted to buy a home, unless you were driving around the neighborhood looking for a FSBO, you went to a real estate office and they get the listings, and they showed you the book. Now we're definitely going to creep in the direction of portal search. That's going to be the new normal. And so, what does that mean for the relationship, and what does that mean for customer behavior? Exactly.
And by the way, the other thing we ask the consumers, and this is they say, which is not the same as what the lender says the source is. So when you ask the lender, they'll say, here's how I got it, self-source, whatever. This is what the customer says the primary reason. And once again, the NPS scores are on there as well. This is a pretty dense slide. So I invite you 27 minutes into this to go back and take a screenshot and study this in your own time. But the ones that are pretty interesting is that second bar over. 16% of borrowers and an 89 NPS score, which is high, say that they had a great first conversation with the originator. That was the primary reason. And then
it's not interest rate?
And it's not interest rate, which is way off to the right. 9% say they know and like the loan originator. So when you combine it, 25% are saying that it's really that relationship with the loan originator, which is why they did it. And then we see the, referrals, the brand, the element of brand is only 4%. 12% say I trusted my agent. So while they're getting the referral and the referral is a driver, it's still incumbent to have the loan officer engage, which is why to me, I'm back to my D's. Though you have to engage on what it is they're trying to do, which is the home, which is their journey, their 8 Ds.
Yeah, certainly not a slam dunk just to get that referral from the realtor.
Absolutely not. 13% say it had a good experience. So ultimately 5% say best interest rate. Now, I know people are going to say, Garth, you're crazy because if you don't have rates, you can't compete. Or if you don't have good rates, competitive rates. I totally agree. It is a competitive industry and all that. However, the consumer's perception is they will not go with you if you don't have a competitive rate, but they're not going with you solely because of the rate. They literally are saying it. They're saying there's some other reason. If you have a great rate and a bad engagement with the consumer, they're going to go engage with someone else who also is going to have a good rate. So the point is, don't get hung up on the rates. You have to be competitive, but you have to be hung up on being sure you have a level of engagement with the consumer to really drive this.
Yeah, if this was a business that was solely based on rate and fees, the modern loan officers we know it wouldn't exist anymore.
Exactly. Yeah, it would be literally. But you see it in all industries, right? I mean, there's wealth advisors who are still do very, very well and help their clients make investment decisions, even though you could go to Vanguard, pick the same mutual fund and pay less.
Yeah,
I mean, we see it all the time.
Yeah, I would argue that the financial services industry has made a little bit more inroads in the customer-owned experience because people trade stocks more regularly than they trade homes.
Yes, that's for sure.
And the proof of that is if you look at the mortgage industry, the direct-to-consumer lenders, they don't do the bulk of the purchase business.
That's right. I think we covered that last time.
Yep.
They do about 80% or 65% of refinances are done through consumer direct, but only 20% of purchases.
That's right.
That's basically.
And talk about competitive rates. It's hard to compete with direct to consumer, but it's easy to compete with them on value and experience.
And especially on purchase. That's right. So the other element here, and we do servicing, we do customer satisfaction surveys with closed loan borrowers. And at the average NPS, and on the previous slide, you saw a whole bunch of NPSs based on different criteria. The average is 77. That's a pretty high score.
Pretty good.
And what that means is that you generally have far more, 77% more promoters who say 9 and 10 that I would use you or recommend, less the people who are detractors 1 to 6 on a scale of 10 that say, yeah, I'm not going to use you again. 77 is pretty good. The average then of servicing, because we then survey borrowers who have loans to servicing, and we ask them, what is your average rolling over time? The NPS score is 28. So there's a 50-point drop. Now, it's a different question. How is your process on closing the loan is different than how is your process overall and how would you rate your lender. But if you're a retail lender where you are both, you are, what this is in essence saying is the relationship elements will go down. Their level of satisfaction will go down unless you really invest on ensuring they stay high. And the only reason I included these other bars is to show you the delta of what is possible. There are lenders who have much higher score than those average, but there's also lenders who have much lower.
That's right.
So the weak challenge I will say to a mortgage company out there, if you don't know your score, you're probably already losing. Because the point is, if you don't measure and find out from the consumer what it is that is driving their level of satisfaction in origination or driving their level of satisfaction in servicing, you really don't have any visibility into exactly whether you're going to be able to own the relationship.
Your opinion, Garth, why does that number fall so low from the time the customer closes through that relationship with servicing? What's servicing doing wrong?
Well, first of all, nobody's going to say, you did a great job clearing my payment this month. Or they're not even going to say, you do a great job clearing my payment every month. You drafted out of my account. The way you drafted on the 10th of the month is fantastic. It's just amazing. Yeah. What they are going to notice is the element of interaction with servicing often is something around anxiety. And the ones we are seeing right now, and by the way, these numbers have gone down over the last few years. And people are like, what the heck? They're going down mostly because of the impact of escrow. And the escrow account number is taxes and insurance are going up. And I know the lenders are sitting there saying, not my fault.
But they're shooting the messenger.
Bingo.
Okay.
They're associating the experience. Or, once again, if you had anxiety, one of your D's is debt, and you are concerned, and you cannot have a conversation that's empathetic, that's exploratory, that's an explanation about why did my monthly payment go up? And once again, it's not the lender's fault that the tax escrow went up, but it's the lender's opportunity to show empathy and engage with the consumer when their payment does go up. And right now, what lenders often do is they wait for the consumer to call them and say, what the hell happened to my payment? And never think about, are you sure you don't want to call the consumer whose payment went up and make sure they understand whether they call you or not?
And we have the data in advance to know where taxes are essentially going up, where insurance premiums are rising. We should be able to be on top of that, right?
100%. And now here's the one thing, and we have not said the 2-letter word AI yet. We've not said it, but I'm going to give a slight one. An AI bot, voice bot, that calls a customer to engage with them about that escrow is extremely inexpensive and can be extremely positive outcome. Now, they may not call you back, and the voice bot might just keep leaving messages and maybe a text or two. But if that message is saying, I know your payment went up and I'm here to talk to you about it, do you understand why? There's the word again.
Yeah.
Do you understand why? suddenly makes them at least say they've acknowledged my payment went up. And, it's a very nice way of maybe just touching them in a really inexpensive way, leveraging AI.
Yeah, such an important point. It seems like we're just always one or two questions away, one or 2 points of emotional intelligence away, and really getting this right.
Yeah. And there, by the way, I will tell you too, that the lenders, some of them we work with, the lenders who have really, really high recapture often are ones who also make a phone call at onboarding on every loan.
Yeah.
Once again, you can do it with an AI bot. Onboarding, you're like, well, what the hell? You just take the loan from origination, you onboard the darn thing, and you collect the payment. Like, what is the magic of that? The consumer, usually the login changes, the UI changed, the origination UI and the servicing UI don't look alike.
Right.
Sometimes the name changes a little because the parent company servicing has a slightly different name than the origination. They sure as heck aren't making a payment to the loan officer. So something's changing at onboarding and making a phone call. And I've got, 3 retail customers that we have really high recapture, and they attribute some of it to the fact that they call the customer on onboarding just to make sure they understood the opportunity to do it online.
Yeah. And in today's age of consolidation, how many servicers have we seen been bought by other servicers?
Yeah, 100%.
And so that number, it's not just the servicing being sold. Sometimes it's the entire company. And are we doing a good enough job informing the customer of what's happening?
Yeah, 100%. Yeah. I mean, we even, by the way, have a term for it when in correspondent, when you sell a loan to an aggregator, and we just call it the hello, goodbye, or the goodbye, hello letter. Yeah. Well, let's think about from a consumer's perspective. You get to a closing and then goodbye. That's my letter that says goodbye. Then the next one, hello.
Is it safe to say that most consumers are not reading Housing Wire and National Mortgage News?
Yeah, 100%.
Keeping up on the M&A of our industry.
By the way, the other element of this, consumers will, and we have this in our surveys, consumers will sometimes be offended by being sold. And this is particularly acute on banks. Yeah. A bank mostly keeps their servicing, but if they don't, or there's some level of a relationship built over time, and then you sold me, like as if you owned me in the first place, that's like, So this chart, by the way, and I start getting passionate and I like run behind the clock, but we'll pick up the pace.
Yeah.
So here on slide 15, this is a very interesting chart from our friends of the Mortgage Bankers Association. This is the retention rate or recapture rate by loan age vintage. And what this is basically saying is if your loan pays off and you get a new loan within the first year, which normally means the rate dropped pretty quickly. The recapture rate's about 26%, 1 in 4. On year 2, drops to 24. Year 3 drops to 20. I mean, very rarely do you get graphs that are so absolutely linear, and the attribution is so obvious.
This is a great example of diminishing returns.
Bingo. Yeah. At 7 years, your recapture rate is half of what it is in the first year. You've had chances in servicing to not have a positive experience, i.e. your servicing experience is dropping, and you've had a chance to be forgotten.
Yeah. I would love to see, and maybe we do this another time, overlay a chart of where the average of taxes and insurance has gone over a 7-year period, just to show what it looks like and see how that, and I bet you it's a direct inverse, because the opportunity is missed in the communication around it, not in the fact that stuff's going up, because stuff is always going to go up, but in the communication piece around it. But
dude, that will be a double access graph.
That's right.
We could do that.
We're going to nerd out on that.
Consultants get charged. We charge extra for 2 axis graphs, so I'm committed to it. I'll add it to the next one.
Finding revenue everywhere.
There it is.
So before the transaction, nobody's watching except them, right? Who's them here? We're talking about the customers. Are we talking about how far upstream should we be engaging the customers, and where are they starting their journey today versus where they started it back when you and I were dropping off?
Well, it was 4 or 5 slides ago. We had the data that we have, like what was the first step that you did, and the biggest first step they did was the search portals. So the whether it's your saved search from your last realtor you worked with, whether it's realtor.com, whether it's Zillow, wherever it is, Redfin, obviously, Compass, wherever it is that you are engaged in a search portal, whether it's online or through an app or whatever it might be, that is often where you are doing things. I mean, I'm guilty of this. If I walk through the neighborhood and I see a house where it looks like somebody moved out, or maybe there's even a sign in the yard, I pull up an app. I'm not going to advertise which one.
I thought you were going to say you look through the windows.
No, I'm not a creeper. So, and so I pull up the app and go, oh, okay, last time that sold was, I mean, there's all this information and there it is. So the search portals absolutely are watching.
Yeah, we talk about more customers today getting their information from social media than ever before.
Yeah.
I talk a lot about this in my daily content on LinkedIn about how we do a terrible job in the mortgage industry and in real estate overall of shaping the narrative about home ownership and what it means. So a lot of customers come into the process with some bias.
Yeah.
That they're going to get bamboozled through the transaction because that's what gets clicks on social media. And so we've got a responsibility in this, and this is a separate topic for sure. But if we're talking about where customers are getting information, where they're starting their search, they're often getting it in areas that is setting them up for a failure of a relationship because they're giving them poor information and incorrect information about what the process really looks like.
Yeah. By the way, I think this next one too, the social media piece is absolutely, growing. And this is really where I think the independent mortgage bankers really shine, partially because the banks will often put constraints on how their professionals are able to use social media.
That's right.
So the banks will very quickly say, you can't do blank, where a good independent will say, here's what you can do and here's how you should do it. There's an independent mortgage banker who has an influencer division. They literally have people who are posting videos and sharing them all the time about how ideas about relating on real estate. There's one of the top independent mortgage bankers who has a whole team of people that are engaging around the Gen Z and millennials and what their challenges might be. But a lot of this is this quick hitting content. And I give you credit for your daily LinkedIn posts. I don't know where you find the time, but those are ways in which that engagement can continue to be something. And if you've hit the holy grail, your consumer who liked you engages with you on social and suddenly becomes a friend or an associate. And now you're able to maintain a relationship as well as understand what's going on with their life.
Mm-hmm.
They had a kid, opportunity to reach out.
Yeah. And we've got so much data now that these opportunities we're talking about from the servicing and lender standpoint, word of mouth doesn't mean what it used to mean because of the data that we have about people and the way that we can find it. But the triggers that are available to a servicer, the triggers are available to a lender for opportunities to form that relationship and to grow it.
Yep.
Different era than it was when he and I first got into the business.
Absolutely.
So 2 experts, 1 stressed consumer. We don't have to spend a lot of time on this slide because we
covered a lot of this in the journey.
A ton of this in the journey. And I talk about this a lot. In fact, I was talking to Bob Brooksman about this last night, about the customer journey and how it's broken. And he was telling me a story about refinancing and getting the wrong disclosure package. And they couldn't get it right. They told him to ignore it, right? Isn't that what we tell customers when they get the wrong documents? Ignore it. So if the CEO of the Mortgage Bankers Association can't get a loan process done perfectly, is there hope for the rest of us?
Yeah.
And so we talk about this going through this journey on the real estate side where the customer is due diligencing the house, the bank is due diligencing the customer, and all of the fragmentation and all of the stress and exasperation that brings. And customers are probably wanting to forget 88% of their loan officers' names after 12 months.
Yeah, 100%.
So here's the relationship graveyard, and this is the key here of what happens after the loan gets closed and what happens after the keys are delivered to the customer and they're moving in. This is where, as a housing services ecosystem, we have massively failed the customer, right?
Yep.
And this kind of gives the timeline of what happens when we get to day 30 plus, day 365 plus, and if we put this into a graph, we'd probably see the same linear motion that we saw on the retention graph. Or in the servicing graph and the NPS scoring.
100%.
Right.
By the way, here is the one. If you have a closing, generally in mortgage, we are guilty of celebrating that is the end. For the consumer, it is the beginning. It is the beginning of their relationship with their home. It is the beginning of the fact they have to move. They have to switch the utilities, concierge services, et cetera. It can help them.
A new era in their life.
It's a new era in their life. If you are good as a loan officer in engaging on the 8 Ds and the why of they bought a home, what it is was the emotional driver. Now your follow-up post-closing and over time can reinforce it. Somebody who says, we have to close this summer because I want the kid in school Labor Day. Well, what that basically means is your conversation, instead of saying, hey, do you have any referrals of friends and family, over and over and over again? How's the kid doing in school?
Yeah.
But if you don't listen, if you don't ask, you don't listen, and you don't put it somewhere where you'll remember, because it's going to be hard to remember, Jones, if you're doing 4 or 5, a top producer, 10 plus loans a month over a year, 100 people, a year later, you're not going to remember. So how old is your kid again? So now they're 6. What are they, going into 2nd grade? What a great phone call. That's their why, not, hey, do you have any referrals, or do you want to refinance?
Yeah. And we talk about on this slide, we say the loan servicer steps in with data, technology, outreach, infrastructure. Those are all things they potentially have, but we see that they're not necessarily implementing them.
Yeah.
So it's not that the relationship is being transferred from the loan officer and the agent to the servicer. It's generally going nowhere.
Yeah.
So something to think about for sure. The servicer wildcard, this has become such an important topic, servicing in our industry.
Yeah.
And so much of it is because the servicers are now originating loans.
Exactly.
Right?
By the way, the one, and this, we talked about this one the last time, the 6 million customers, that Mr. Cooper had suddenly becomes 10 million with Mr. Cooper. And Rocket does a very effective job of recapturing their refinance opportunities.
That's right. You made that distinction between the refinance and the purchase opportunities.
Exactly. But the big thing that we see is that the lenders really struggle almost universally. There's a few exceptions with the purchase opportunities. And the reason is because in some ways it starts the whole ecosystem again, the realtor involvement, the realtor referral. But the other element is the first loan, our surveys show 50% of the time, one of 7 things happens that reduces the borrower's NPS. They don't love you. It wasn't a wow experience. Now, if you hit them up, remember the refinance stats, and you make an easy, clean refinance, they might just do it. They have a relationship with you. You haven't messed up their servicing. Your SAT's okay. And you give them a compelling pitch at the right time, they might jump on it. Absolutely. Even though maybe the service levels were not amazing. But on a purchase, they're going to start the whole cycle again if you miss the opportunity for the wow on the origination and you miss the opportunity to maintain a really high level of satisfaction on the servicing.
But the bar is low enough that if you just do some of the basics, you're in better shape than most of your competitors.
Exactly. Yeah, absolutely.
The servicing to origination play. Now, this used to be the origination to servicing play.
Yeah.
We're in a new era, a new dynamic.
100%.
So let's talk about, the servicing. They've got the data, right? And this is again, there's more data than we've ever had. The amount of data that somebody could dredge up on you and I by the time we finish this webinar, staggering.
And the amount of, and the ability of AI to make sense of it is compelling. Yeah. And if you have experimented yourself with ChatGPT, you are learning quickly how compelling it might be to just have some AI things. I mean, now, if you're a loan officer, do not take your pay stub and stick it into ChatGPT and ask it if it qualifies. Please don't do that. That is not what I'm saying. Experiment with ChatGPT in your real life.
Yeah.
So ask it, how do I program this remote control? Ask it, all the other goofy things in your life, and it will answer, and it's amazing. The other is it will also answer in the context of other questions you've already asked it. That's also what's happening in the data. It knows that Jones is closed on a certain date, and suddenly there's an outside third-party data. The old world said, if this binary event occurs, print a report, and I'll make a phone call. AI is saying a bunch of things have occurred with this record. Call this guy.
Yeah, I saw a vendor demo here at this conference yesterday where they not only take all those elements of data, but they do exactly what you just said. They help the loan officer, they help the agent, and because they're industry agnostic, they help them synthesize that information and actually create some valuable outreach to the customer. So like you said, it's not just, hey, I know you started school. It's, hey, I know that your kid started school. I know that we talked about your child starting school, and you mentioned that they're going to have a teacher they really like. How's that relationship working? It's adding contextual layers to it, and it's creating the opportunities for that data advantage and the trigger events to actually be meaningful and not just, hey, your rate's at 5, I've got 4.5. Do you want to pull the trigger on this thing?
100%. Here's the one. If you survey your borrowers and you know their customer sat scores over time, and you maintain that as part of your data advantage, it suddenly is going to tell you a bunch. because the customer is telling you, I'm not happy with my servicing relationship and I just listed my home for sale. That may be a different campaign than the person who is super happy and just listed their home for sale, because you're already starting from a likelihood you're not going to get that next loan. So you got to overcome it. The flip on it is to say, I'm not going to call them at all. It's kind of if I'm busy, I'm going to call the ones where their level of SAT is high and they just listed their home for sale, because I'm more likely to get that one. So either way, you can make decisions on how you use the data. But if you don't have the data around their level of satisfaction, it's just a black hole. They're assuming that, that they're all fine.
And to me, this speaks also to the importance, because I don't want to leave the real estate agents out of this part of the process.
Yeah.
While the loan's being serviced, that's still an opportunity for the agent to be involved, for the agent and the loan officer as a team to be involved in creating relationships that are lasting. So just know that this servicing to origination play, those originators, they do want those deals, and they have an advantage in getting it, whether or not they do, right? They're generally doing a poor job of it, but that's an opportunity for loan officers and real estate agents and mortgage companies to keep those relationships going.
Well, and I think if you're competing with Rocket and Redfin, and Rocket and Redfin perfect this and have Redfin or real estate experts, let's just call them real estate experts, not get into the agent or whatever. A real estate expert talks to the consumer periodically about trends that are happening in the neighborhood. They're not trying to sell them. They're not trying to list them. They're just making themselves available to answer questions through a bot, through a phone call or whatever, because it's all part of the same ecosystem.
That's right.
So now you're beginning to combine those elements for the right segment of customers. There it is. There's my slide. There's the slide.
Yeah. So we talked about the Rocket companies and Redfin and what they're trying to create. We've talked about this in the first.
Yeah, first one too.
In the first one. So we don't have to spend too much time on this, but this is what companies are now trying to create. And this is why we're having this webinar series, because we're trying to figure out, how do we reach the customer? How do we create a singular journey for them? And I hate the phrase or the nomenclature of putting the customers in a singular funnel, because, like I said before, that really widgetizes the customer. I like customer journey, customer process, customer experience.
100%.
We're not talking enough about customer experience. And companies like Rocket, that's putting a lot of money into this. And they're trying to figure out, how do I make all three channels of lending work? We've got the broker, we've got the retail, we've got the direct to consumer. How do we make that work? And how do we create a similar excellent journey? One of the things that you talk about when you talk about McDonald's and the success of fast food is that they create a similar journey everywhere, so that if you're in a McDonald's in Afghanistan,
franchise the model,
right? And you've got to create that singular experience for the customer that at least seems familiar to them.
By the way, I have no intention of being at a McDonald's in Afghanistan, but I appreciate your comment.
I'm just teasing it. It could be where we are next month for part 3.
No, I don't think
but
so. We're going to stay domestic.
Garth's taking it off the table. That's fine. The agent relationship stack. This is kind of the where does the agent live in what the customer journey is? And we know that now more than ever, customers are using the portal and the MLS
to get started.
Yeah, and the MLS means something very different today than it meant 40 years ago. Because 40 years ago, if you wanted to crack at the MLS, you had to go look at the big binder that the agent had. And so now we've got all of these different elements. We have the emergence of the team in real estate, something that didn't exist, probably 20 years ago at the scale it does now, where you've got little teamerages that work under the brokerage platform. So you've got all these layers of where the customer puts data in, and the customer actually goes from being someone who's just casually looking at real estate to a lead. All of us open up Zillow. Garth just told you about what he does when he drives around the neighborhood, but he's not filling out forms, because if he does, then he becomes a lead for someone. What happens to that? And there's plenty of leakage there. And all of these things, where it starts at the consumer controls where they want to talk, where they want to have their transaction go through, what's important to them, and who they're working with. But it all starts with the consumer at the top of the stack. There's whether the agent is solo, part of the team, if they're dealing with more elements of the brokerage, but all of these different elements are collecting data from the customer, and they're all using this data in some way and creating a different customer journey just about every time they go through the process.
Exactly. So I think we see a similar one on the mortgage side. The one thing I will say, though, and this will be the challenge for the Rocket Redfins, Mr. Cooper combo plans, and Compass, et cetera. There is the top CRMs in the mortgage and the top CRMs in real estate have no common names. And the only common name is Salesforce. And Salesforce, though, is for those of you who know Salesforce, every Salesforce instance looks different anyhow.
That's
because
right.
It's been so heavily customized.
They do have one thing in common, though, Garth.
What's that?
The adoption rate is about 20% on both sides. Extremely low.
Very, very true.
Yeah.
The piece I'm getting is the point of sale on the real estate and the point of sale mortgage, not the same names. There's no actual integration of technology at really almost any level between the origination and the real estate. They're passing information back through voice, texting each other, or email. That's generally how it's being done. And if somebody combines it, because think of the power in the data that the realtor has and the lender has. Wow. And so I think that really is. Now, once again, there's only one Rocket Redfin Mr. Cooper, and there's a whole bunch that aren't Rocket Redfin Mr. Cooper. And if you're watching and you're not Rocket Redfin Mr. Cooper, you absolutely can compete, but you better compete at a pretty scrappy level. Mm-hmm. So that your relationships with the realtors need to be cultivated and made even stronger, because they may not be Redfin agents. You better be darn good. You have a real wow customer experience that makes them want to come back. You want to be sure that the servicing related piece, if you're retaining your servicing, does not degrade the relationship over time. So you got to be on your game, because they do have an advantage, or apparently have an advantage, as they begin to aggregate all this data and maybe begin to seamlessly integrate the technologies. But boy, we all know integrating of technology is a tricky one. And by the way, the last one is servicing systems and loan origination systems aren't the same either.
That's right.
Now they're under in Vegas, the same company, mm-hmm. But even ICE has sessions for the MSP people in servicing and the origination people over here. It's not the same system. It's two totally different systems that work totally different and have, frankly, different technologies. So this is, as much as we are looking at this and saying, holy cow, how am I going to compete? This is a daunting task to try to put this data and these systems together.
It is, but now more than ever, we talked about in part one about how technology is both the opportunity and the driver.
100%.
Because it has gotten so fragmented, it has gotten so complex that it's almost necessary to find that solution. But that's also the opportunity, because we are more poised now more than ever to be able to create that solution. And by the way, we're also at the worst point in time to create that solution, because we're just going to get better tomorrow and the day after that.
Exactly.
So the opportunity is there. So where the relationship actually lives, Garth just talked to you about the CRM and how the CRMs don't talk to each other, and how there's no cohesive workflow between mortgage and real estate now, right?
No. It's, once again, even just like, hey, I signed the contract, DocuSign. I then get a link to a loan application, and I start all over. New username, new passwords. Ultimately, in some cases, then during process, I might be working in an LOS, new username and passwords, or definitely. And the other one we do, and when we do consulting, we sit there and say, do not ignore UI UX. UI UX, the user interface and user experience, is what maintains confidence that it's consistent. When they see a system that looks completely different, the customer sort of goes, am I in the right spot? Mm-hmm. Because that doesn't look like what I did. And when you get down into the servicing thing, they always look different. And you're like, what is that? Like, am I starting all over?
And if you need any proof of whether or not the customer feels confused through the journey, how often, if you're a loan officer, you're an agent, does the customer call you asking you a question they should be calling the other person to ask, because they don't really know who controls that process and who owns it? And when you tell them you don't know and you have to get back to them, if you do, that's okay. Yeah. But that initial, that speaks to them that, hey, there really isn't a cohesive journey here. 100%. This agent referred me to this loan officer, and it doesn't seem like they're communicating.
Very good point.
So the converging claim, integrated models win by owning every layer. So we've got some bubbles here. We've got the consumer's in the middle of it all. So talk us through this Venn diagram.
Yeah, I mean, really, what the Venn diagram is sort of saying, it is not a natural Venn diagram yet. And it is a challenge. And I kind of did the voiceover in the previous slides about it, because the real estate brokerage piece, and you broke that down into the 6 elements, and the mortgage lender piece, and whether it's the yellow or whatever, those, and the servicer, there's very little overlapping. And the servicer and real estate brokerage, there's no overlap.
Yeah, and I touched on it and said, hey, I didn't want to leave them out in that slide, but then we look here and we see there's a delta there.
If they're not, there's nothing, but that doesn't mean that couldn't be.
That's right.
And that's why I sort of was talking about the fact that I would like to get real estate advice, even though I am in the servicing experience right now. I'm not listed my home or anything, but home values going up or down. By the way, where the closest we get to this are some of the platforms that keep telling customers monthly or on periodic updates what is happening with real estate in their area. Are the values going up? Are the values going down? How many were listed for sale? That is, in essence, the combination of trying to get a real estate brokerage type experience with a loan servicing client. And those are effective because at least they do remind consumers of some level of what is happening as well as who the heck you are. But as we see in our data, it degrades over time.
Yeah. And, you know, and I have to think, just based on what we talked about and looking at this Venn diagram here and seeing that gap between loan service and real estate brokerage, seeing the numbers we saw, which probably isn't a mystery to people in the business, but although, you know, maybe some ignorance, but not a mystery. And it certainly wouldn't be a surprise. But is the next evolution of loan servicing that has origination tied to it, or has a lender at least tied to it, is that next evolution, is that bottom loan servicer bubble starts to merge into some relationship with the real estate brokerage so that we can actually close the gap here and bring customers back once they close a loan with us? I have to think that's going to happen.
Yeah, well, certainly I think is the investment thesis and the play for you know, Rocket, Redfin, Mr. Cooper. By the way, can we come up with an acronym for that? Let's ask them. Is it, you know, RRMC or something? I don't know. It's hard to say Rocket, Redfin, Mr. Cooper.
That sounds like good LinkedIn content. So thank you, Garth, for that idea.
Yeah, Rocket, Redfin. Let's think about it.
So here's a good question to pose. If your best agent or LO left tomorrow, how many other customers would know your company's name? So this is a question aimed at the brands out there that are hiring loan officers and have licensed agents. So what's the value of the brand? And we saw that in the customer survey that it was about 4% of customers actually care about the brand.
Yeah, or the primary thing was the brand.
Primary thing. I suspect that's about the same for the real estate brokerage. So if I'm a real estate brokerage or if I'm a mortgage banking executive listening to this, what's the takeaway? Does my brand matter?
Well, they are making big brand bets. So you need to have a strategy of how you compete with a big brand bet, because you're not going to run Zillow ads at the pace and the expense of Zillow and Rocket and Rocket and, you know, PennyMac suddenly at the Olympics apparently is a consumer brand. I had no idea. Yeah. So suddenly, you know, there is an effort to create branding to the consumer about this experience. The trick in mortgage has always been, if you get a loan every 5 years, the branding effort is staggeringly expensive because they just don't need it. You're 95% of the people you're throwing your brand message into, they don't need your product.
And they've been marketed to by the servicer every single month, as you said.
Exactly. So but if the ecosystem is broader, the marketing investment begins to be a little more compelling. And
so
I think
another argument for vertical integration.
Another argument for vertical integration, because you can kind of afford to do some level of marketing. One thing I had, and it just hit me, so what the heck, I'm just going to say it.
Let's do it.
Is that a few slides ago, we had a view of like the who owns the data and the tech stack for agents and loan officers. And if I was a loan officer right here and it just hit me, or a branch manager or whatever, I think I might take those, print them, and say to my best realtors, hey, I want to talk with you about something. What do you think about vertical integration? So use our job aids and take it out there and say, so this is one of the things that I've been thinking about it, or share this video with them and say, you know, how are you thinking about it? How are you going to succeed even more in the future? Because I want to be your partner and I want us to collaborate on what we are going to do about this. Because not everyone's going to work for Redfin, right? So, you know, those RE/MAX agents, you know, might want to take a call and talk to somebody who's thinking the same way they are. How do I compete in a new climate when so much of this vertical integration is occurring?
Absolutely. I think it's one of the most fascinating things about our industry is that we keep evolving, we keep growing, the customer changes, the needs change, the housing markets change. There's so many dynamic things within our industry that to pay attention to. There's always an opportunity to learn and to grow and to get better. So how'd we do?
Wow. Well, we did 1 hour.
All right.
The last time we did 45 minutes. So apparently these are now, the next one is going to be 75 minutes. And by the end, it's going to be an intermission.
Yeah. And not in Afghanistan. So
yes,
we took you through this journey of who owns the customer relationship. Next up, part 3, from service silos to connection, how vertical integration is redefining the next era of housing. I just teased that in the last slide where I talked about the dynamic changes that are happening in our industry. We've brought you up to this point where we've talked about the different issues we've got. And I want to start in the next one. We're going to talk about what the future is going to look like in the next 5, 10, 15 years.
Oh, wow.
Super exciting, right?
Yeah, that's So for me, the next 4 or 5 weeks are conferences. So I'm gonna, be appreciative looking at lens out into the future. So it'll be fun to engage on that.
That's right. And if you're watching this, please let us know where you think Garth and I should get together and do the next one.
Yeah.
Would love to take your suggestions. Obviously, the Middle East seems to be off the table right now, but that leaves so much more of the world. So please get your suggestions in. We're excited to talk to you next time. I want to thank Garth for doing a tremendous job today and for working with me through this. This is a lot of work to put these together, but it's a labor of love because we both love this industry so much and we want the best for it.
Yeah, I appreciate that. And the idea of having an opportunity to hang out in a hotel is, while creepy, it's been a good time doing the presentation. So we'll see what it is for part 3 next time.
Absolutely. Thank you for joining us. We'll see you soon.